Welcome to the deep dive. We're here to sift through complex info and hopefully give you those aha moments. Today, we're tackling a really persistent puzzle in finance, the value versus growth stock debate. For decades, investors have talked about this value premium, the idea that, well, these overlooked value companies consistently beat the flashier growth stocks. But how reliable is it really? Can you actually bank on it to beat the market consistently, or is it more nuanced? So, let's explore this. Today, we're diving into some pretty groundbreaking research. It's by Hussein Glen, Yu Hongxing, and Lu Zhang, and it's called Value versus Growth, Time Varying Expected Stock Returns. And what they do is use this really sophisticated nonlinear model to look at how the premium behaves, not as some constant thing, but something that shifts, sometimes dramatically, with the economy.
Yeah, and what's really fascinating here is how it challenges some basic assumptions. We often think about returns as, somewhat static, but this paper really pushes us towards understanding the conditional nature of returns, meaning what you get isn't fixed. It changes depending on the, let's say, economic weather. It gives us some key insights into when value might outperform growth, and maybe just as importantly, why and when it might not.
Okay, let's set the stage first. Basics. What exactly are value and growth stocks? So value stocks, generally, high book-to-market ratio, right? The market price is maybe low compared to their actual assets. A bit traditional, perhaps less exciting, but potentially undervalued.
Exactly. Solid, established companies, maybe.
And then growth stocks are the opposite. Low book-to-market. These are the innovators, the ones priced high because everyone expects big future earnings, rapid growth.
That's the idea. Lots of promise, lots of expectation baked into the price.
And the value premium is just. The extra return value has historically gotten over growth. It's been, well, a big deal for a lot of investors.
It really has.
Yeah.
And the debate about it, surprisingly intense, actually. Earlier studies use these, well, simpler models, linear predictive regressions. They assume things are kind of steady. They found some suggestive evidence, hints of this premium, but it was still pretty controversial. Some researchers even argued it didn't change over time at all. No time variations, they said. Basically, it's either always there or never there, predictably.
Yeah.
But this paper, it comes at it totally differently, uses a nonlinear model. It's designed to catch those shifts.
Right, and that's the key innovation, isn't it? This two-state Markov switching model sounds complex, but the idea is pretty intuitive. Instead of assuming the market just chugs along steadily, this model says the market can kind of jump between different states, different modes, like it has moods.
Yeah, exactly. Two distinct moods, or gears is a good way to put it, specifically high volatility periods and low volatility periods.
And this nonlinear approach, this jumping between states, that's what lets us see things the older linear models just couldn't, like looking in color instead of black and white.
Perfect analogy. It captures the dynamics. The model identifies these two states very clearly. State 1, the high volatility state. State 2, the low volatility state. Now, it's important to note the high volatility state often lines up with recessions, but not always. Think about, say, the October 1987 crash, or even the late 90s tech bubble bursting lots of volatility in growth stocks then. Those weren't necessarily full-blown NBER recessions, but they definitely count as high volatility states in this model. It's about market turbulence, uncertainty.
Okay, now here's where it gets really interesting for me. How do these two types of stocks, value and growth, react differently in these two states? Especially when, the economy starts looking rough.
Yes, this is the core finding. The difference is stark. In the high volatility state, get this, expected returns of value stocks become most sensitive to worsening economic conditions. Meanwhile, growth stocks are the least sensitive in those same high volatility times.
Wow, really? So value takes the bigger hit?
In terms of sensitivity to bad news, yes. The numbers are quite telling. Look at the loading on the default spread that's a measure of credit risk, the gap between risky and safe bonds. In the high volatility state, values loading is 7.76. Pretty high. Growth loading, only 4.60.
So value reacts almost twice as strongly to that credit risk signal.
Pretty much. When things get turbulent, value feels that economic pain, that risk aversion, much more acutely. And it's similar with interest rate shocks. Value firms show a much stronger negative reaction to rising short-term rates in that high volatility state compared to growth firms.
Okay, so in rough volatile times, value stocks are way more exposed to those negative economic shifts. What about the low volatility state then?
Totally different story. In the low volatility state, both value and growth have insignificant loadings on that default spread, around 1.29, 1.06. Basically, they don't react much to changes in credit risk. Their expected returns based on other economic factors. They become much more comparable. The huge difference in sensitivity just evaporates in the calm state.
Wow. So the market isn't just like up or down. It has these fundamentally different operating modes that completely change how stocks behave. That changes everything, doesn't it, in terms of how you think about risk?
Absolutely. And this leads directly to the paper's main point, the time-varying expected value premium. Because value is so sensitive in the high volatility state and growth isn't, the expected outperformance of value, the premium, it spikes upward rapidly during those turbulent times. Then as things calm down, it tends to decline more gradually.
And are the numbers significant? Like, how big is the spike?
Oh, they're substantial. Get this. Conditional on being in that high volatility state, the model predicts the expected one-year return for value stocks is 11.21% per year.
Okay, pretty good.
But for growth stocks, in that same high volatility state, expected return is negative 1.17%.
Whoa, negative. So you're actually losing money on growth while value is expected to do well over 11%. That's a massive swing.
It's huge, over 12 percentage points difference just based on the market state. But then, look at the low volatility state. Value is expected at 10.90%, growth at 10.26%. Almost identical.
So the premium basically vanishes in calm markets but explodes in volatile ones. That completely turns the simple value always wins idea on its head.
Precisely. The context, the market's mood is everything.
And they base this on solid data, right? You mentioned the time frame.
Yes, very solid. Monthly data, January 1954 all the way to December 2007, over 50 years. And they use standard predictors. T-bill rate, that default spread you mentioned, bond minus corporate bonds, money supply growth, dividend yield. Pretty standard, reliable stuff.
So this robust data combined with that clever Markov switching model, that's what unlocks this insight that the older linear models just couldn't see.
Exactly. Those linear models, they fail to capture the upward spike of the premium, like in the early 2000s downturn. They just smooth it all out. They show much weaker variations in other volatile periods, too. They just aren't built to handle these abrupt jumps between market regimes like the nonlinear model is. It gives a much, much more accurate picture of history.
Okay, so why? Why do value firms react so strongly when things get tough? Is there an economic story behind this pattern?
There is, yeah. And it ties into what are called investment-based asset pricing theories. There are a few key reasons.
Okay, break it down for us.
First, think about operating leverage. Value firms often have higher fixed costs relative to their variable costs, like big factories, heavy equipment.
Right.
So when revenue drops in a recession, their profits fall faster and further than, say, a software company with more flexible costs. That higher operating leverage makes them more affected by negative aggregate shocks.
Makes sense. What else?
Second, costly reversibility. It's harder for these value firms to scale back quickly. You can't just easily sell half a steel mill if demand drops, right?
No, probably not.
Their assets are less flexible. It's costly to shrink operations. So when the economy sours, they're kind of stuck with these costs and assets, which hurts their bottom line more than firms that can adapt more easily.
Okay, operating leverage, costly reversibility. Anything else?
Third one is financial constraints. Value firms, historically, are often more leveraged. They carry more debt. When the economy gets shaky and credit markets tighten up, having a lot of debt becomes much riskier. They face higher borrowing costs, maybe struggle to roll over debt. This makes them riskier, so investors demand a higher expected return, especially in those bad times.
Okay. So these three factors, operating leverage, costly reversibility, and financial constraints, combine to make value stocks particularly vulnerable or sensitive during those high volatility periods.
Exactly. It provides a solid economic rationale for why we see this pattern in the data.
So it adds this layer of nuance, right? Maybe value stocks aren't just always less risky, as some older ideas suggested. They're conditionally riskier, specifically when the market's in that high volatility state.
That's a perfect summary of the implication. The risk profile isn't fixed. It changes with the economic environment. And just to add, the paper also finds these changes in expected returns are linked to changes in conditional volatilities, how much prices swing around, and also conditional Sharpe ratios.
The Sharpe ratio, return per unit of risk, so those change too.
They do. Interestingly, though, even with a higher risk in bad times, the average conditional Sharpe ratio is actually higher for the value group overall. It's about 0.66 per year for value versus 0.38 for growth. So on average, maybe better risk-adjusted returns long-term, but with that nasty conditional risk.
Okay, this is fascinating for understanding past market behavior. Deep insights. But here's the million-dollar question for listeners, right? Can we actually use this? Can this fancy model help predict the future and make better investment decisions like now?
Right, the practical application. And this is where the research delivers a rather humbling message. The bottom line is, the out-of-sample predictability of the value premium is close to non-existent.
Wow,
I know.
non-existent. So even though the model explains the past beautifully.
Exactly. It's brilliant at explaining what did happen and identifying these states after the fact. But trying to use it to reliably forecast ahead of time which state we're entering and capture that premium spike, it just doesn't seem to work consistently in a way that generates significant, reliable extra profit in real-time tests.
So how did they test that? Did they try building a trading strategy based on the model's predictions?
They did. They set up a simple rule. If the model predicts positive excess returns for, say, the value portfolio next month, you hold value. If not, you hold safe treasury bills instead, a basic timing strategy.
What happened when they simulated that in real time, using only data available at each point in the past?
Well, the results were mixed and ultimately not compelling. For growth stocks, the switching strategy did have slightly higher Sharpe ratios than just buying and holding. But for value, it sometimes underperformed buy and hold. And the authors themselves caution that this might just be a mechanical result, kind of an artifact of how the test was set up, because the simple strategy didn't even use all the model's info, like its volatility forecasts. It wasn't sophisticated enough, perhaps.
But you mentioned earlier that value spikes in high volatility states. Did the timing strategy work then?
Yes, that's the crucial caveat. If you knew perfectly after the fact when the NBER recessions were, or when the model identified a high volatility state,
Using hindsight.
exactly, using hindsight,
Yeah.
then yes, these switching strategies did massively outperform buy and hold during those bad periods, like that growth example. Buy and hold lost 1.5%, but the hindsight switching strategy made over 12% annualized during recessions.
But you can't invest with hindsight.
Precisely. That's the problem. You need to know in advance. And the model, while great historically, doesn't provide that reliable crystal ball for the future state transitions. And interestingly, in the good times, NBER expansions or low volatility states, these timing strategies actually underperformed simple buy and hold.
So trying to time it could actually hurt you during the good years, and you probably can't reliably catch the upswing in the bad years anyway.
That seems to be the tough reality based on their out-of-sample tests. It really underscores how difficult real-time market timing is, even with sophisticated models.
Yeah.
Identifying the state after it's happened is one thing. Predicting the turn is another game entirely.
Okay, so let's wrap this up. What are the big takeaways from this deep dive into Gulen, Xing, and Zhang's research on value versus growth?
Well, I think the clearest insight is that the value premium is definitely real, but it's not constant. It's strongly time-varying. It tends to spike, sometimes dramatically, in high volatility environments, often recessions, but not always. And that's because value stocks become much more sensitive to worsening economic conditions during those periods.
And we learned why that happens, things like operating leverage, costly reversibility of assets, and financial constraints hitting value firms harder in tough times.
Exactly. The economic intuition is strong. And the research really highlights the power of using these nonlinear models, like the Markov switching approach, to actually capture these dynamics that simpler linear models just completely miss. They reveal a much richer picture of market behavior.
But then comes the crucial practical point.
Yes. Despite understanding the past so much better, the ability to use this model to reliably predict the value premium out of sample to actually trade on it profitably in real time seems close to non-existent. It's a powerful reminder of the limits of forecasting in finance.
So, this deep dive really shows that understanding the why behind asset behavior is incredibly valuable, even if it doesn't just hand us a simple trading signal. It informs how we think about risk and portfolio construction. And it leaves us with a thought, doesn't it? If even these really complex, sophisticated models struggle to predict reliably out of sample, what does that truly tell us about trying to forecast the market? Maybe our focus as informed investors shouldn't just be on predicting the next move.
Perhaps it should be more on understanding the different market regimes, the underlying economic drivers, and building portfolios that are robust, that are resilient across different potential environments, rather than betting heavily on predicting the unpredictable.
Something to definitely ponder. Thanks for breaking that down.
My pleasure. Fascinating paper.
Join us next time for another deep dive.